Hi everyone, and welcome to our webinar today, which we are running exclusively for Steadfast brokers. Today we're going to explore the key differences between manufacturers, errors and omissions cover and traditional professional indemnity policies. But before we start the session today, I would like to briefly cover a few housekeeping topics. So today's webinar will be recorded and the link will be sent to you in the next couple of days. Please feel free to revisit it or to share it with your colleagues. Throughout today's session, we'll also be running a few polls. At the same time, we're going to invite your comments and questions. Hopefully you can see the Q&A chat box on your screen, and if you think of a question for us, just type it in there and we'll try to answer these during the session. If you don't get to your question, then we'll follow up with an email after the webinar. If you are having issues with sound, please try disconnect and reconnect. And if that still doesn't work, you can try the call-in number provided in the audio options on your screen. Finally, with regard to CPD and CIP points, a certificate will be emailed to you so you can claim them, claim the points for today's session on the NEBA or ANZIIF websites. And for those of you who don't know me, my name is Kirsty Owens. My role at Berkeley is to oversee the portfolio of business underwritten via the SCTP. In addition to this, I've specialised in underwriting financial lines business for many, many years. I'm joined today by my colleague Rebecca. Rebecca is an accomplished financial lines and liability underwriter within our Sydney team. To kick off today's presentation, I'm going to cover traditional professional indemnity policies, including a bit of the history of how these have developed over the years, and looking at a working definition of what we actually mean by a professional. So what is professional indemnity insurance? Well, if someone alleges that your client's made a mistake, overlooked some critical information, misstated or misrepresented a fact in the course of providing professional services, and then this results in a financial loss to a third party, then that third party might want to take legal action to recover the losses. Therefore, professional indemnity insurance is designed to protect professionals from such claims of negligence or breaches of duty which result from the professional advice or services that they provide. It's important to highlight, for the purposes especially of today's webinar, that most traditional professional indemnity policies contain a supply of goods exclusion, which you can see here on the screen. It might also, in other insurer policy wordings, be referred to as a manufacture, construction, or installation exclusion, depending on whose wording you might be looking at. The purpose of the endorsement is to say that claims relating to the supply of product is distinctly different to the provision of professional services. Now, there are some exceptions that apply to this, and I will touch on these later through the session. Now, turning to the history of how PI policies have developed. So the first policies were negligence-based, and they generally only covered losses where it was shown that the insured owed a duty of care to the claimant, that they breached that duty, and that breach caused a loss to the claimant. Then act, error or omission policies broaden this cover to also include contractual liability, statutory breaches, this includes things such as misleading and deceptive conduct, and breaches of fiduciary duty and breaches of trust. So breach of professional duty wordings, as their name suggests, require there to be a breach of professional duty, and this needs to be proven. So these insuring clauses need to be considered very carefully to understand what specific duties within the provision of services actually are professional or regarded to be professional. For instance, incidental activities such as clerical duties, for example, that don't require particular expertise, skill or technical qualification, they might not be regarded as being a professional duty as such. So wordings need to be read carefully, as some breaches might be excluded. And so, for instance, when a policy might include contractual liability within the extensions, most policies will also exclude liability assumed by the insured over and above common law. Within civil liability wordings, these are generally regarded as being a broader policy coverage. They typically provide cover for claims arising from civil liability incurred in the course of performing professional services. There's no requirement to provide a breach of professional duty, as is the case with the breach of professional duty wordings. So civil liability, as the name suggests, is liability that arises out of civil law, as opposed to criminal law. So criminal liability, or penalties that could be imposed by statutes, would not fall within this coverage. The fact of the matter is that both civil liability and act, error, or omission wordings provide broad coverage under both. However, the focus of each is different. So civil liability policies focus on the nature of the liability, so i.e. whether it's civil or criminal, whereas act, error, or omissions wordings focus on the actual conduct of the insured. At the end of the day, if you've incurred a civil liability, the chances are that you've engaged in some act, error, or omission for which you are liable. But what do we mean by professional? Well, this is slightly more difficult to define. As a term, it's not prescribed in law as such. So generally, a professional is considered a person who holds specialized knowledge or skills, usually through higher education, such as provided by universities or similar type establishments. They owe a duty of care in the performance of professional work. They're usually paid a fee for the advice or design work. And that fee would be separate to the sale of a product. So it's quite a clear differentiation between the two. And the duty might be owed in tort, such as the civil wrongdoings, as we mentioned earlier, as well as in contract. And not mentioned in this slide, but also another indication is membership of a professional association. So for example, things like the Law Society or the Institute of Architects. An architect is considered professional because they have specific qualifications and training that enables them to design buildings. The average person does not. Claims could be brought against them for failing to adhere to building regulations or client design specification. So the standard of care expected by professionals is typically that of a competent person who meets the standard of practice accepted by their professional peers in their relevant discipline. So this slide provides a list of some of the typically accepted professional occupations that we would see on a daily basis. And of course, in my role, it would be wrong of me not to include.
Kirsty, we just had the poll on the last slide.
Oh, sorry. Oh, sorry. Yes. Thanks, Rebecca. Yeah, so going back to these professions before we move on, which of these occupations would you consider to be a professional? Hopefully everybody can see the poll on their screen. So those answers are just coming through now. I think we should get a very good response seeing I've basically given away the answer. Okay, can we see the results of that poll, please?
So 98% of people have given us the correct answer, that is vet, and 2% of people believe that a manufacturer of specialized components for washing machines is to be considered a professional. So well done to 98% of people.
Thanks, Rebecca. Right, so moving on to the next slide. As I was just about to say, a shameless plug here for the Steadfast client trading platform, of which we recently started providing auto-rated PI quotes. And most of the occupations that were actually mentioned on the previous slide are available for auto rating under the SCTP. So obviously the auto rated quote gives you full quote and bind within seconds, 26.5% commission for Steadfast brokers, very fast turnaround on quotes and referrals, all handled by your local Berkeley underwriter. Back to the presentation. That pretty much covers the slides on what is a professional indemnity policy. So in a minute, I will hand over to Rebecca, but I mentioned in one of my earlier slides there are a number of policy wordings, and some of them are listed here, although this list is not exhaustive. The two that I really wanted to draw your attention to are design and manufacture. So I mentioned earlier that PI policies will have an exclusion of goods, or sometimes referred to as construction and manufacture exclusion. So these two PI policies are specifically tailored to the industry. So in these, you would see that exclusion does not apply, but however, they are still very much a professional indemnity policy and require some sort of professional service to have been provided in order for the insurance clauses to be triggered under those. Now, before I hand over to Rebecca, I just wanted to check, are there any questions that have come through so far that brokers would like me to answer? No? Looks like we're good. I would expect most of you to be fairly familiar with what PI policies are, but it was really important to provide a base of that understanding so that Rebecca could then lead into her session. So I'll hand over to you now, Rebecca.
Great, thank you very much for that, Kirsty. Okay, so next slide.
Over to you.
Awesome. Let me just find the slide. Has the slide disappeared? Oh, I can't see that one. Sorry, technical difficulties. Give me a second. Okay, apologies for that. So yes, thank you very much, Kirsty, for going through the PI element. So yeah, as Kirsty said, it is really important to have an understanding of what PI is and who should have a PI policy in order to understand what manufacturer's E&O is and who should have that coverage in place. So let's get started. So I'm just going to be going through the E&O basics. So you will be quite familiar with what a general liability policy is intended to cover. So as we know, a general liability policy will only cover claims arising from property damage or bodily injury claims. So a manufacturer's E&O extension can help fill that gap by giving you and giving your client some coverage for financial loss where their product has failed, but there has been no property damage or bodily injury claim. So what else should we know about the coverage? Well, a lot of brokers seem to think that it is a faulty workmanship coverage, which is, of course, not right at all, because it doesn't generally cover any cost of repair, reconditioning, replacement, or making good the product that you have supplied. Now, as I've said, most importantly, and this is probably the biggest misconception that we have when brokers are sending risks down the SCTP, it is not a PI coverage. So yeah, if you're, I dealt with one just before the webinar where the broker is requesting a $1 million E&O coverage because the client has a contractual obligation to have PI in place. If your client has a contractual obligation for PI, unfortunately, manufacturer's E&O is not going to cut it. They will need a full-blown PI policy. Again, if your client is a professional, so the examples that Kirsty gave earlier, again, they're going to need a full PI policy in place. Or if your client is giving any sort of professional advice for a fee, then these sorts of claims are going to be excluded on the manufacturer's E&O. So a manufacturer's E&O extension is not going to be good for them. Another major importance of the manufacturer's E&O extension is the fact that it is a claims-made extension. So I appreciate that a lot of a lot of you may not deal with PI on a regular basis. So what do we mean when we say it's a claims made extension? So a claims made extension requires that a claim is notified during the period of insurance. So if you're dealing with a client on a renewal and they have a E&O extension in place on their general liability policy, you need to have that conversation with them to see if there's any sort of complaints that they've had from customers or situations with products that could result in a claim. There is no coverage for facts or circumstances which the insured was aware of prior to the commencement of the period of insurance, and there is only coverage for acts, errors, or omissions that have occurred on or after the retroactive date. Therefore, as I said before, if you are even in doubt of a potential claim being in existence, then you should be notifying the insurer. So, as I've mentioned, with the retroactive date, as standard on the SCTP, Berkeley's E&O extension, there is a default retroactive date of inception. So only the underwriter can change the date on the endorsement. If you have a client who has an existing E&O extension on their GL policy, you need to let us know because we need to match the E&O extension retroactive date. So just refer it back to us or give us a call, and the underwriter will generally ask for maybe the expiring schedule so that we can note the same retroactive date. It's really important for the client when it comes to a claim made extension or policy that there is continuation of cover in place for them. So again, stressing the importance of the manufacturer's E&O policy to your client, it is becoming more important due to continually contracting supply chains. There's no longer any sort of flexibility to handle any disruption or issues, and manufacturers, we find, are getting pulled into more lawsuits because of that. So it is really important to speak to your clients about any sort of large contracts that they might have picked up. You might find that as your client is growing, they do tend to seek on to take on larger, more sophisticated clients, and that puts them at a greater exposure for an E&O claim. I would certainly say if your client is on selling to any sort of large multinational such as Coles or Woolies, Chemist Warehouse, Priceline, then they should absolutely be considering an E&O extension because these are large companies and very sophisticated, and if there is a financial loss claim, then they will certainly know where to go for it. And I think something at the moment which is probably quite topical is problems with supply chains. So we are seeing that there is distribution issues, getting goods into the country. Ask your clients about how that is affecting their product. If they cannot supply their product, how quickly can that product be replaced? Or how quickly can it be shipped in from a different manufacturer or supplier? Because this is all going to affect the likelihood and size of an E&O claim against them. So we're going to have a quick poll on this slide as well. So the question here we're asking is, if you have a manufacturer's E&O extension on a GL policy, have you checked that the retroactive date is correct? So let's have a look at the answers for this one, and I'm hoping it will be mostly A. Awesome. Okay, so 94% of brokers are checking the retroactive date, and I can't stress the importance of this enough. It's really important to make sure that the client is getting a continuation of cover on that extension. Yeah, thank you. So moving on, we sort of covered the basics of what the E&O extension is. So what sort of client is at higher exposure for an E&O claim? What sort of clients should you be really selling the extension to? So generally, if you've got a client who is manufacturing a component, they do tend to be more highly exposed for these sorts of claims. Generally, if that component can't be used in the end product, then production of that end product is held up until a substitute component can be found. And generally, as is the case, there are multitude of different components used in a product. And when that's a situation, it can be really hard sometimes to find where the product failure is coming from. So even though your client's product might not be the one that's at fault, all the suppliers can get pulled into a lawsuit. Is your client's product specially made to specifications? If so, there will generally be less substitutes for it to be replaced with, and a disruption claim is more likely there. Does your client outsource part of their manufacturing work? If they are, what checks are they doing to ensure that the product quality is being maintained, especially if it's being manufactured overseas? Is your client responsible for printing and packaging of the product? I will say here, when it comes to printing, especially food products, many food recalls can be down to non-disclosed allergens on packaging. So clients who are responsible for printing and packaging of products, again, have a heightened exposure while the labeling or product is being replaced. Has your client had a previous recall or allegation made against them? And if so, how have they mitigated against that? Does your client have high production runs? And if they do, how are they keeping track of batches and what batch testing is being conducted? I will have a claims example later on, which really kind of highlights the importance of this as well. When discussing E&O limits with your clients, you should also be thinking about the maximum exposure for their E&O claim. What is the value of their average and largest contract? Again, I will point out, make sure you know who their end clients are. If they are large multinationals, large contracts, then you really need to be discussing the importance of the E&O extension. I would also make a point of you should be getting into the habit of checking the government's recall website, because that's a really good way of sort of starting to understand products. And if you look on the recall website in a fairly regular way, then you will see certain trends coming up when it comes to certain products. So again, if it's a food product, you'll see a lot of recall claims for undeclared allergens on packaging. I've seen a lot of bike-related recalls recently, and it does tie into the E&O extension because it helps you understand what sort of problems can occur with your client's products. So next slide. So again, we've discussed the limit. How can you sort of ascertain what is the best limit for your client under the E&O extension? Like I said, have that conversation with them, check what their average and largest contract is, and go from there. If your client is selling to retail only customers, and like I said, we get asked for the E&O extension a lot, and a lot of the time it is for clients who are maybe only on selling to retail clients like me or you. If that's the situation, is there really an exposure for an E&O claim? If something were to go wrong, if I were to buy a packet of chips that the packaging wasn't correct, what's the exposure for me? So again, if your client is on selling to a wholesaler or a large multinational retailer, that's where the exposure is. A lot of time we will be asked just to match the client's expiring policy. I know that there are some general liability wordings out there that do automatically include the E&O coverage, but we do charge an EP for the coverage. So we're not going to quote it for nothing. And if you can explain to your client why they don't need the extension, then you'll be bringing a lot more value to them. So in terms of the limits that we offer, more typically we do offer maybe a $250,000 or $500,000 limit for E&O on the SCTP. Again, we do get a lot of requests for $1 million, but when this happens, it brings a red flag to an underwriter because it makes us, it could indicate that you or the client think that it's a PI coverage, which it's not. When I get a request for $1 million coverage on the E&O, I'll generally just have that conversation with the broker and just make sure that they know what the coverage is, that the client doesn't need PI for a contractual obligation, and sort of have that conversation from there. So the coverage we offer under the SCTP is an aggregate coverage and does include defense. And you will notice that Berkeley underwriters will generally apply a higher excess of at least $5,000 on the E&O extension. So what are we looking for in terms of outside and inside appetite when it does come to the E&O extension? So outside appetite for us, I would say printers. So you'll notice on the printer codes on SCTP, we do have a printer's E&O exclusion. So we're not intending to cover any of those claims. We write a lot of PI for printers on open market. So if you do have a printer client who needs that coverage in place, just send us a submission on open market and we'll look at it there for you. We won't offer the E&O extension for any trades, construction type risks. We won't offer it for cleaners. Trades or construction type risks should really have a D&C policy in place. Again, if your client requires it or wants a quote for it, just send a request through to open market. And finally, any professions, look back to the examples that Kirsty gave earlier, any professions we will not be extending the E&O coverage on simply because they're not a manufacturer and they should have a PI policy in place. So what sort of businesses, activities are within appetite for us? Well, we do tend to write a lot of E&O for small to medium-sized manufacturers. However, we are quite cautious when it comes to high hazard component parts, such as those that are safety critical or involved in automotive, health, or medical. Okay, so I'm just going to start going through the claims examples now on the next 3 slides. When it came to the claims examples, I really wanted to use them to explain some of the details that we've already gone through. So with the next claim, I wanted to highlight the difference between a GL claim and what could be an E&O claim. So we're going to have a poll on this as well. I'm just going to read out both scenarios. And at the end of it, yeah, just confirm which would be a GL claim and which one would be an E&O claim. So scenario 1 is manufacturer A manufactures chair legs. They supply to manufacturer B, who uses these components in manufacturing their range of high-end hotel furniture. Manufacturer A was accused of supplying defective parts, which led to their chair leg snapping and several injury claims brought by hotel patrons. Scenario 2, the defect in the chair legs was found prior to manufacturer B using them in the manufacturing of their hotel furniture. This range of furniture was required for a new hotel opening 6 weeks later, and the chair legs could not be remade in time for the opening. Manufacturer B was unable to meet their contractual obligations and lost the contract, resulting in significant financial loss. There's a keyword there which should tell you which is which. And I will try and work on more creative claims examples. Okay, so we have a lot of answers in already, and 79% of you have been listening. So correct, the first example here, scenario 1 is more likely going to be a GL claim, and scenario 2 is going more likely to be an E&O claim. So well done. So on the next claims example, I did just want to highlight the importance of evaluating your client's supply chain when you're deciding on a limit and the likelihood of an E&O claim against your client. So I'll just read through this example. Scenario 1 is the client manufactures and distributes pies to independent service stations. Each service station buys no more than 50 pies daily to sell on to the end consumer. An error in the declaration of a known allergen on the packaging means that the client is unable to supply pies for a week. Scenario 2, client manufactures and distributes pies to a pie wholesaler who then on-sells them to service stations. An error in the packaging means the pie wholesaler is unable to distribute the pies for an entire week, losing $500,000 in revenue, and they also lose a large account for being unable to fulfill contractual requirements. So which of these two scenarios are more likely going to result in a manufacturer's E&O claim? Which one has the greatest exposure for a financial loss? Okay, so 200 responses so far, with 85% of people giving the correct answer, which is scenario 2. Yes, they are dealing with a larger retailer or wholesaler who has a much larger financial loss than these independent service stations. You know, when you're dealing with a service station that has 50 pies per day, you're not talking about big money, so it's unlikely to result in a E&O claim. Okay, so for the final claim example, this one was a Berkeley E&O manufacturer's E&O claim. So the insured was contracted to manufacture a batch of chocolate bars under an agreement with the claimant, who in turn sold the product to a supermarket chain. The supermarket's customers complained of spots on the bars with a mold-like appearance. The supermarket chain made a decision to recall the affected batch of product, and a claim from the cost, including loss of sales, was brought against the claimant. The claimant, in turn, sought indemnity from the insured. The claim amounted to $49,000, consisting of loss of sales and cocoa bean costs, which had been supplied by the claimant to the insured for the manufacture of the chocolate bars. Following investigation, it was found that the mold-like appearance was likely to be a result of the insured using larger salt granules in the defective batch of chocolate bars. So I like this example because it highlights the heightened E&O exposure when you have a client who is on-selling to a much larger business. And also from this example, it also stresses the importance of batch testing and batch controls. So in this particular example, the client was able to mitigate their exposure by limiting the recall to only the affected batch. And they were also able to pinpoint exactly what the problem ingredient was so that future batches were not similarly affected. So that's all from us. We hope you are now much more knowledgeable on what is PI, who should have PI in place, and what is manufacturer's E&O and who should have that coverage in place. Again, you know, the main points that you should take away from this webinar today is that manufacturer's E&O is not a PI coverage. It is a retroactive coverage, so you need to be checking your retroactive dates, and you know, every client's exposure for an E&O claim is different, so make sure that you're having those conversations with them to assess what their limit should be and if the coverage is even required at all. Any questions?
Thanks, Rebecca. We've had actually quite a lot of really good questions throughout your session on different occupations and where the sort of two covers might fall. So we're happy to share those hopefully I've answered all the questions as they've come in, but we can share those with the attendees after today's session.
Excellent. So yeah, if there's no more questions, yeah, I guess we'll finish up there a little bit earlier than expected, but yeah, we'll tie everything together at the end. Everyone will get a copy of the webinar. It will be available on our website as well with probably the next 24, 48 hours, and we'll send everyone a copy of the questions and answers.